All right, guys, welcome to another episode of the Report Saturday edition. And today we are going to replay a conversation I had this week in our boutique hotel investing mastermind community. I had on one of our boutique hotel investing lenders. This guy's been in the space for quite some time, doing a lot of hotel loans for decades now across the country, different markets, understands the capital markets very, very well, one of the best in the game. And he joins us today on this call, and you're going to see in this call, he talks about the tariffs, how it's going to affect interest rates, how it's going to affect the ability to borrow money in the capital markets. But more importantly, you're going to hear a little bit of doom and gloom in this call. He really believes there's going to be a lot of opportunity ahead in the next 6 to 9 months as we navigate through 2025, just with all the volatility in the marketplace, the stock market crashing, etc. So stay tuned for that. We're going to talk about hot markets, cold markets, because remember, in a hot real estate market, access to capital is very easy. Debt is very easy. Equity, ability to raise equity is really easy, but it's very, very hard to come by good deals. And it's very, very hard to find deals where you can come in at a good cost basis. Now, on the flip side, when market conditions turn, there's a lot of turmoil, there's a lot of bad news, there's a lot of fear and uncertainty. In those types of markets, lending dries up, capital markets dry up, it becomes more and more challenging to secure lending and raise equity. But on the flip side, there's more opportunity and becomes a lot more easy to find deals. So he's going to talk about where the opportunities are, what he foresees in the marketplace. Keep in mind, there's a little bit of doom and gloom in here. Personally, I'm rooting for some more volatility, for some more uncertainty as we navigate through 2025, because personally with Summers Capital, we have a 10-year time horizon with all the deals that we're acquiring. And so what happens in the short to midterm, I'm not too concerned with. So I'm rooting for some good buying opportunities as we navigate through the remainder of this year. If you guys like this episode, remember, this is a conversation from our boutique hotel investing mastermind community. We currently have almost 100 members, almost 50 hotels owned now collectively amongst the community, action takers, positive, forward-thinking, like-minded individuals. We're doing our mastermind retreat this October down in Tulum, Mexico. It is going to be absolutely sick. If you guys are interested in learning the boutique hotel investing game and getting into the boutique hotel investing game, you can go to summerscapital.com/mastermind to book a free call with my team. And without further ado, let's jump into the show. Today's guest, repeat guest now, and someone who provided the financing for the Surf Break Hotel up in San Clemente, the most recent deal that we acquired, and doing big things. The guy does a lot of loan volume in the hospitality space, both branded hotels, independent hotels, and has been in the game for quite some time, understands the capital markets, and is in the know. But he does all the financing for us, and excited to have him on to talk capital markets and all the stuff that's going on with the economy right now. Suraj, welcome to the call, man.
Thanks for having me, Rich.
Yeah, absolutely, man. Pumped to have you on, dude. And there's so much to cover here. And with all the volatility in the marketplace, I wanted to bring you back on and talk about it. But first things first, man, talk about how the tariffs and all the volatility in the stock market is affecting the capital markets and the debt markets right now.
Well, I think there's a short term and a long term. The long term is very speculative, but I would say in the short term, it just creates... it just makes lenders want to take a pause because they don't know what's going to happen in the market. Obviously, right now there's different media and different news that comes on every day that sort of sways the market up and down. Like today, there was some positive news that there's going to relieve the tension on what effects the tariffs could have. But every single week, it's an up and down environment. It makes lenders sort of want to take a step back and take their sort of foot off the pedal. And it also may make the equity markets also take their foot off the pedal a little bit. And everyone's going to sort of wait and watch, right? In a volatile market, people need to make, loans aren't typically 6 months or a year for the most part. In the fixed rate market, they're 5 to 10 years. Mm-hmm. So people want to make a long-term decision. So when, in these sort of up and down volatile markets, banks sort of don't know what to do. So they do end up taking a pause. Like we've had current deals in the market that, a few of our lenders said, like, come back to us in like a month or 2 months because they sort of want to see what happens and what's sort of going to take place, especially when these guys reach a new trade deals. And then after they reach a deal, like what kind of impact that new deal has on the market. So it's kind of wait and watch right now, unfortunately.
For any real estate investors that have refis that are pending or even acquisitions that are pending, is this something that they need to be concerned with, assuming that they're already through a decent amount of the process?
For people who are in the middle of a process, I mean, it is a little bit alarming. I mean, they should be a little bit concerned about, because obviously with lenders, and everyone's had this experience, and we've experienced this ourselves. We're pretty much at final committee meeting, a lender can say, we're holding off on all lending. And the reality is that even in certain states, you have a commitment letter from the bank, and they still have the right to say, we're not going to lend to you. So it should be alarming. But at the same token, if you have a loan that exits out your current maturity, move forward with it. And, as long as the bank says that they're still moving forward, I would go with that trust and just sort of move forward, because, a new loan sounds great. If you have a bank to lock you in for the next 5 to 10 years, that can be like advantageous for you, especially in a volatile market. But a lot of people do feel that banks will try, and this is just because of short history over what we've seen the last couple of years. They're most likely banks will not put people into default. If they start to pause on lending, banks can't just put all their clients that are maturing into default. I mean, they may do it on a one-off basis, but for the most part, we have seen modifications and them to provide extensions, like every 6 months or a year. I think banks do tend to work it out with clients, and that's what we've seen post-COVID, and that's what I think we'll continue to see. I mean, it's not guaranteed, but I think for the most part, banks don't want to go into litigation at a time like this, because it's also a volatile time for them, not just for investors.
Yeah, and I think it's important to remember, like, even these bridge lenders, like, they're not trying to be operators, especially in the hospitality space, which adds a lot of layers in terms of operations. There's a lot more layers that you got to consider. So I know all our lenders, like, they're not trying to be hotel operators, and so I think that a lot of your bridge lenders, private lenders, they're going to be flexible. They're going to want to work with you. So extensions and all that sort of thing is definitely something that is in the conversation. Now, when it comes time to, obviously perm debt, a lot of this stuff is DSCR restraint. And if you're talking boutique hotels, especially smaller hotels, they're kind of sub $10 million, you're going to be looking at a lot of regional local banks for perm debt. Mm-hmm. What's the sentiment with the local regional banks, and how are they looking at the current situation that we got going on in front of us with the tariffs?
I mean, I think with local and regional banks, it's always a case-by-case scenario. But I do anticipate them to also take a pause. But that's not really like a sort of a doom and gloom thing, right? Because it's not like this pause is going to extend out for the next year. I think people are just sort of waiting for some news. But I do think the market is in maybe not as great of a shape as it was a few weeks back, but I still feel there's liquidity in the market. And I do think banks have a lot of comfort in the collateral and their existing portfolio. Except for office deals, I think lenders have used good parameters post-COVID. A lot of deals had good equity in. So because the collateral is strong, and if there's new deals, as long as the collateral is strong, I do think that you'll be able to find some capital source. But I do think that to that question, I do think it's bank by bank. But if they do take a pause, unless if there continues to be negative news, that pause could be short-lived,
Yeah. And if you think like, big picture macro perspective, I mean, personally, I think with the tariffs and some of the stuff that's going on right now in the stock market, I personally think the volatility is good. And I think it puts some pressure on the Fed to do some rate cuts. But I also think that there's going to be opportunity as you look out the next 3 months, 6 months, and even 9 months. If you're one that's looking to acquire more assets and you have a long-term kind of vision and time horizon in mind, personally, I'm kind of rooting for some more discounts in the marketplace. So maybe talk about where you might see opportunities for people investing and acquiring assets in the hospitality space as we look out and navigate through the rest of 2025.
I look, I don't have a magic ball, but I would say the next 9 months will be incredible buying opportunity. I do think that all this sort of dialogue that we're seeing in the market, or all the press that we're seeing, that the lending markets may tighten, pricing may tighten, because even if rates continue to drop, I mean, we saw that in CMBS over the last week, that even though treasuries have dropped, spreads have widened. So the all-in rates have stayed the same. Some have even increased. So I don't necessarily know if these new trade negotiations go south, if lower rates will save us. But I do think that there's going to be an opportunity to buy. And I think that this entire business, more than lending, I mean, I think it's a basis play. Every single deal is a basis play. And for people who have their equity ready, for people who have, I mean, if I was on the investing side, what I would do if I was a GP, I would sort of like sharpen up my pencil, look for assets like carefully over the next 6 to 9 months, because they're going to be available. And I would have a very solid business plan to present to my investors that, hey, for the next year, we may have an interest reserve that pays our debt service for the next upcoming year, because our property isn't going to be profitable because there's some turmoil in the market. But for the most part, the foreseeable future, it's good collateral that you're getting at a discounted price. So when the market tends to come back, because we've seen this history with up and down markets throughout the entire financial history in U.S. When the market comes back, you'll see that you've made a good chunk of equity buying something at a discounted price point.
Yeah, no, absolutely. You nailed it on the head there. I think your going in basis is where you make a lot of your money. And I think as long as you can buy in a good location, you have a clear path to add some value, and you can buy at a good basis, and you have a long-term time horizon, that's an asset that you should definitely do a deep dive in and consider acquiring. You mentioned one thing. You said, definitely have some equity lined up. How much is track record? Because obviously, the capital markets are going to tighten, and the ability to get lending is going to tighten in a time like this. Over the next 6 to 9 months, lenders are going to be very cautious. What can real estate investors do, hotel investors do, to kind of present themselves to lenders from a place of strength? Because I imagine track record and resume is going to come into play a little bit here too.
Yeah, I think track record, experience, and case studies, which all goes into track record. I think sponsors profile, if they're taking on a deal that they can show case studies that they've done before, I think that always wins it. If they already have some footprint or some asset near the market that they're looking to purchase a new asset in, I think that all will go into, because just like borrowers are concerned about a difficult market, so are lenders, right? They want to lend to good collateral, but then they can't just look at the horse. They want the right jock on top of that horse. So someone that has experience, someone that's done this before, someone who has a history of executing. If you're doing a basis play where you say you bought something for, let's just use 10 million right now, and then you have a history of putting, you put in $2 million of CapEx, and in your projection, you're showing that year 3, it's going to be worth 16 million. But if you can show the lender that you've done this a couple of times and show them case studies, because a lender is able to do research using CoStar, using RCA, a bunch of different resources to figure out what you bought it for. And if they can validate you as a borrower that you've been able to execute successfully, I think it's going to be an interesting time for people with experience. I think it's going to be a great time to buy, in my opinion. I could be wrong about this, but I think the next 9 months, there's going to be a good opportunity to purchase at good price points. And I think experience is key.
Yeah, absolutely. And if you don't have experience in the hotel game, it's even more important to partner with someone that has experience. And that's what rooms like this are here for. This game's all about being in the right rooms. But again, you don't have experience. I think now, more importantly than ever, it's going to be more important to partner with someone that's done it before. So when you go to get lending, you go to raise capital, you can have that track record and you can leverage that other person's experience. Suraj, you go to a lot of conferences. What's the sentiment out there in the marketplace when you're talking to other lenders, but also other investors at these conferences in terms of their outlook for the rest of 2025? What are you hearing?
I mean, I think borrowers are concerned. A lot of the hotel conferences that I go to, people own anywhere from 5 to 20 hotels. Some people own 2 to 3, and a lot of the owners that I do know, they've also created their own third-party management company, so they sort of operate themselves. And over the last 24 months, we've seen massive increases in labor costs, payroll, insurance, and real estate taxes. So those costs have affected what people see on their bottom line in net cash flow and sort of profitability. So, and I think going through it for the first 6 months or 12 months, it's nothing new. But now the longer this time drags on, the less and less sort of savings and liquidity people have to exercise on growth. But again, I know it sounds all negative, but that's why the opportunity comes. Good opportunity to purchase property and buy something distressed or discounted doesn't come when everyone has money and lending is open. It comes when lending is relatively limited and equity in the market or liquidity in the market has sort of dried up. So I think people are struggling, but the people who've been in the industry for some time and have saved up money and have created a business plan and presented that to their investment partners, so their investors are also understanding of the current condition of the market and know that the reason they're being active in a difficult market is because they're going after property at a discounted value. I think that will bear some fruit.
Yeah.
I think the people who buy in difficult times, they're usually the ones who, in the long run, tend to be most successful as long as they can hold on during that difficult time.
Yeah. Because you really have two different climates, right? You have one climate to where debt is cheap, it's easy to get lending, but there's a ton of buyer demand, and it's impossible to find good deals. But then you have this other climate where it's exactly the opposite. Debt is hard to come by, lending is not cheap. It's hard to get deals done. It's harder to raise money. We just did a raise right now. I think generally speaking, liquidity for most Americans is at an all-time low. We've been in a high rate environment for 36 plus months now. And the way most Americans re-up on liquidity is they refi their primary residence. And so even if you're a doctor or an attorney making $400K, $500K a year, you still have expensive mortgage to pay. You still have car payments. Your kids are probably in private school. And so even those folks haven't been able to refi and re-up on liquidity. So I believe most Americans are all-time low with liquidity. And then if you look at what's going on with the tariffs and the rate environment, I think things are going to definitely contract from the capital market standpoint. But like you alluded to, now comes opportunity. So I'm excited to kind of see how these next 6 to 9 months kind of navigate and see what kind of opportunities shake loose from this. I know with us here at Summers Capital, we're looking at, a lot of our projects are, long-term time horizon, 10 plus years. So for me, a little bit of volatility doesn't scare me. I'm excited for the opportunity. What are you thinking and what are you hearing in terms of rate cuts from the Fed, assuming this volatility continues for the next 3, 6, 9 months? What are you projecting? Obviously, we know it's all speculation at this point, but what are you projecting in terms of rate cuts potentially for 2025?
The Feds on monetary policy are also wait and watch right now. They've been pretty outspoken about it. They are definitely, they've vocalized how difficult, if these negotiations don't go out well, they're saying that it would have a massive ramification, much worse than what people think. The one thing about our global economy, GDP, it's all like one big, it's all dominoes, right? It's not checkers or chess. So once you knock down one domino, like everything affects one industry, affects another. Like because of these tariff news, if you're in industrial, a lot of lenders on the industrial side, bridge lenders are sort of scaling back because that's going to be one of the first asset classes that are affected. But I think everyone right now is wait and watch because in the next few months, there may be a lot of speculation. There may be a lot of press releases. There may be a lot of news that sort of makes the publicly traded equities market up and down. But in terms of lending, I think the easiest thing for investors or lenders to do is just to take a pause. And I think the Feds, like Jerome Powell has publicly said that they're sort of taking a pause. They're not going to quickly reduce rates, but obviously if there's massive turmoil in the markets, they're going to have to reduce rates. But if these tariff negotiations go terribly based on everything that we're reading and what's being presented to us and what lenders are saying to us, that lowered interest rates won't necessarily solve the problem.
Can you expand on that? What do you mean when you say lower interest rates aren't going to solve the problem? Hey guys, real quick, I just wanted to personally thank you for listening to this podcast. It means the world to me. The only way this show grows is by word of mouth. If there's anyone in your circle that could benefit from this podcast, it would mean the world to me if you could share it with them via text or maybe on your Instagram story. And I'll be sure to keep an eye out on my Instagram for shares so I can reshare you on my Instagram story. Again, thank you so much for listening, and it means the world to me. Now back to the show.
I think if valuations go down, right? Like I think leasing will be short-term leases, which then affect any sort of perm financing, right? I think on the hotel side, ADR occupancy will all take a hit. To be honest, we truly haven't really even fully come back from COVID in terms of the hotel industry. I think tourism markets is the only sort of segment that's truly come back. But I think when no one even uses the term primary market when talking about hotels, because all the primary markets in the country have been hit the hardest, besides maybe, primary markets in the Sun Belt. But everywhere else, New York, San Francisco, Chicago, I think the markets are still coming back. And now you have this, this new situation regarding tariffs that could have a massive impact on all sorts of our sort of national GDP, just spending in general. I mean, I think everyone, it's hard for me to talk about too many details, but we're constantly seeing videos in the news that eggs are too expensive. Like, when's the last time you've seen any article about eggs being too expensive? I think all these additional costs and inflationary risk that people are seeing has had an impact on people's liquidity. And I think as spending gets tight, I think it's going to have a discount in valuations, and then lenders will be insecure about the value of collateral. But that's where again, if you have a business plan and your investors are ready, where you have, a strong check and you have history, you're going to be the first one. You're going to get access to buy collateral, because there will be bridge lenders that take advantage of this market, and they'll be expensive. It won't be the prettiest terms, but there will be bridge lenders ready to sort of come into the market and execute on deals. But everything will have to be perfect. It'll have to be good collateral. It'll have to be an excellent business plan by a group that has executed this business plan before.
Yeah. On that note, I know we acquired a deal end of 23 that was a repossessed deal, foreclosure, that our bridge lender took back from the developer, and we were able to pick it up at 65 cents on the dollar because of that. Do you foresee more foreclosures happening, especially in the bridge space? And do you see that as an opportunity for investors to come in and maybe pick up some of this product?
I do think that there's going to be, we're seeing it more over the last 12 months on auction sites. We're seeing more lender-owned properties. But in the bridge space, there will be some one-off deals that lenders try to release properties. But I think with lenders, they're also insecure about their future business, right? If they sell off a deal that's underperforming, they will their first efforts, if they feel like they've tried everything they could, first, they will try to work something out with the borrower. Secondly, they'll try to sell the note to a different lender, because that they can do quietly. They don't have to publicly
take the asset back on your book.
They don't have to initiate with a brokerage and publicly market the asset, because it looks bad on them, right? It shows bad to their investors. So if their entire book of business they have to sell in the secondary market or on auction sites, it's unlikely that after they're done disposing all their collateral, that their equity, because even these lenders that are debt, they're also, they also come from equity. It's equity supporting their debt mandates.
They're trying to save face.
Yeah. So they'll have to, they know how they'll have to close shop. So I do think there's opportunity, but I think that it doesn't come as quickly, because I think their first option is to work it out with the borrower. And the borrower will try whatever he can to try to save the asset, whether it means, I think the better opportunity is if you have a group that's ready with equity. If you find out any of these groups that are sort of reeling or struggling to keep up with their asset, is maybe buy into their deal, put some equity in, get it at a good basis, and then provide your expertise in the market or your current portfolio to find him some capital, him or her some capital. But I do think that lenders will work first with the borrower, then they'll try to sell the note to another lender, to another debt fund, to another bank. They'll try to get it off their books and try to do it quietly. I think the last option is to because usually they're sort of required to auction the property if they have to foreclose on a borrower. And lenders don't like running hotels, especially if it's boutique and if it's not primary market. They don't like to engage a third party hotel company and then have them manage the property for them. They just feel like it's a lot of work, and at the end they still have to auction it anyway. So they'd rather just get it off their books and sort of cut the bleeding, stop the bleeding.
Yeah, absolutely. Yeah, I think we got lucky with the one we picked up from our bridge lender because they did 0% financing for the first 6 months. They kept it on their books. They did a 2-year note. But I know their initial note to the borrower that foreclosed was probably low double digits. And so they did 0% for 6 months, and then it converted into 5.9 with a 24-month term. So we'll be refinancing out of that one end of this year. It's kind of crazy to me, like when I think about how the last 36 months have gone. For one, if you would have told me 36 months ago, hey, the rate environment would essentially double for 36 months and there wouldn't be any major recession or any major discounts in the real estate market, and more particularly in the housing market across pretty much the entire nation, some housing markets have actually gone up. Now, the one thing around that is the stock market has held up pretty well. And so I think when people look at the health of the economy, they look at the stock market and how it's performed. And it wasn't until the last, month and a half, really last 45 days, to where we're starting to see, the stock market have some volatility. A lot of days where the stock market is down 2, 3, 4, even 5% in a day. And now all of a sudden the media's got a lot of bad news in the marketplace. Everyone's talking about recession. Everyone is concerned, but it's all stemmed by the stock market.
Well, I think it's some way it's linked to the fact that there's been a lot of liquidity in the market. People were sort of flush with cash post-COVID, and then we entered into one of the lowest interest rate environments in history. And then people were selling, then they did 1031, they got stimulus money. Like every single market was up. Stock market, the real estate transactions were happening, the crypto market. I mean, people were sort of flushed with capital, like after 2020. And I just feel like there was a lot of liquidity in the market, and that allowed people to, and I think that's why people are concerned right now, because I think the liquidity has sort of run out, and that's when things are getting more expensive. And that's when, with all this tariff news in the market, I think this was sort of a difficult time for the stock market to sort of showcase what it's been doing the last 3 weeks. I think we've had this incredible run for about 15 years, and there's been an insurmountable amount of liquidity built up in the market. And now that's finally sort of, I don't think it's fully dried up, but it's still very much dried up at this point compared to where we were 2 years ago.
Yeah, I mean, that's a great point because if you guys remember, 2020 happened. For the first 3 months of that pandemic, I mean, a lot of people were gearing up for a big recession. But then the Fed, took rates down to zero, printed a ton of money. And then there was a bunch of stimulus checks that were handed out. And the following year, 2021, ended up being one of the hottest real estate years ever. A ton of money chasing deals. Or you could get debt at 2.5%, 3%. And it just became like a crazy bloodbath market with everyone just chasing a lot of deals. And so we saw a lot of inflation. And then 22 was when the Fed started to first announce the rate hikes. But relatively speaking, 22, 23, 24, for most people, I mean, it's been more, there's been challenges, but for the most part, it hasn't been as bad as people would have thought, knowing, hey, the rate environment's going to double for 36 months. But now we're seeing it. The last big crash in the stock market I remember was like 2008, right? Because the stock market in 2020, it went bananas. I mean, there was a little bit of a crash for a month, and then it went bananas.
There was like sort of a massive crash, but then the stimulus just completely turned things around.
Yeah. And people were thinking in 21, man, like, hey, if the whole world shut down and there was no recession, people were not afraid to buy. And so we saw a little bit more of a run there. But how bad do you foresee the potential of this kind of reset here? I know recessions typically aren't as long as people think they are. They're typically pretty rapid and pretty quick. But how dramatic and how extensive do you see this potential recession lasting?
I mean, I'm always optimistic. I personally think that this is going to last 12 months, but you never know. I mean, everyone's wait and watch, so it's sort of kind of silly for me to answer that question because everyone else who's sort of smart and who we're listening to is wait and watch. But I personally think that there's going to be great buying opportunities for the next 9 months, and I think. I do think that historically, what we do during these moments, when there's financial crisis, when there's a recessionary period, is that at least in the U.S., it's always been quantitative easing and interest rate reduction. And I think we're going to go back to those basics. I don't know how much easing there's going to be because I think they don't want to create another inflationary period. But I think the basis will be so low on these properties that because another thing is we haven't seen price points go down, like you said, in the not just in the residential market, but even in commercial real estate. And so imagine what these price points would be if rates went down. So I think over the next 9 months, people should just sort of keep an eye out, call all their investment sales brokers, call all their banks or debt funds that they know that they have a relationship with, and let them know that they're well capitalized, that they have liquidity, and they're ready to make a move because there will be a good opportunity to buy. And I don't foresee this lasting too long, but it all depends on what ends up happening on these trade agreements. I mean, I think it's impossible for me to say, but I feel like this is only going to go on for a year. If I were an investor, I would be looking for property over the next 6 to 9 months because I think you could already sort of see it. I already feel like prices are lower than they were 6 months ago on all asset classes. I would say cap rates have slowly gone up over the past year and a half. And I think that that's only going to continue over the 6 to 9 months. And there will be a little bit of unraveling from the banks. It won't be a lot because I think they don't want to go under. But I do see some dispositions being out there.
Yeah. And I think in addition to that, I mean, if you guys look at all the listings that have, time on market, we're talking 6 months, 12 months, 18 months plus on market. Right now you could probably use some of the bad news in the marketplace to go circle back with a lot of those buyers or a lot of those sellers. Because now some of this bad news, they might be willing to let their assets go at a more of a discount and come to more reasonable terms. When you say quantitative easing, we know that that's a way for the Fed to inject capital into the economy and the money supply without creating a bunch of inflation. What exactly is the definition of quantitative easing, and how does that work without creating inflation?
Well, I think quantitative easing, very simply, it's just printing more money. The Fed's printing more money and throwing it back into the market. On a very simple way of defining it. And what the Feds are trying to do is try to develop credit in the market, and that's by the GDP. Our GDP sort of runs cyclically. I mean, one trade forms another trade and then forms another trade. So I think just to get sort of the flow of credit going, that would be sort of their goal, and they would put stimulus out in the market to sort of encourage that. But I do feel because of how much stimulus was in the market last time, I think that will sort of they'll be most hesitant to use that method. I think the easier thing to do and the more likely option is lowering interest rates.
Yeah. On this notion, we know the Fed has printed somewhere in the realm of 80% of the money supply since 2020. A lot of that coming right after the pandemic. We know a lot of that money has kind of been on the sidelines with the higher rate environment. I mean, the last few years you've been able to get 4.5%, even 5% risk free in a CD. when do you see a lot of that money that was printed over the last 4 years? When do you start to see that start to trickle down into ADRs, asset prices, etc.?
I think that's a good question. And again, that requires me to speculate. I've always felt over the last few years that we've seen all this inflation, but we still haven't seen the true inflation in ADR yet.
Right.
I do think that ADR has gone up slightly. Like a property that was doing 120 ADR in 2019 is now doing 140. But yet, if you compare that to the inflation by percentage or the inflation ratio to everything else for the consumer, I still think that ADR is going to shoot up. You see certain brands entering like the mid-scale and economy segment that have always been an upper scale, because I do think that they're also targeting a price point in that lower segment because they see pricing going up everywhere. Look, again, this is my hypothesis. This is just my guess, but I do think that ADR throughout the board will increase substantially. The only place that we've really seen a lot of success in the hotel segment is tertiary markets and travel and tourism markets. I don't think that we've fully come back from COVID. And then people even said, even around the time of 2020, 2021, that the hotel market will fully come back in 2025. But now we have this, all this stuff on tariffs coming up. So I think in New York City, San Francisco, certain markets are finally starting to make some headway, even in Chicago, but they're still a ways from coming fully back. But I do think that we'll see a massive hike in ADR in the upcoming future. But that's, again, just my guess. I mean, I can be completely wrong on this.
Yeah.
But I think that the inflation that we've seen in other forms of consumer spending has not trickled down into ADR yet.
Yeah, absolutely. Why do you say that, primary markets, or why do you think that primary markets, generally speaking, have not recovered the same way a lot of these tertiary, more rural tourism markets have?
I mean, I think, the corporate segment is different. I think work from home, stuff that we've already seen. I mean, you could see it in the office segment in these primary markets. I mean, they usually have a corporate sector that's much lower in occupancy than we've seen historically. I do think that other markets, particularly the entire Sun Belt of America, there's been growth. So maybe that took away some of the dynamic of the markets that have dominated in this country historically, like New York City, Chicago, LA, San Francisco. I think there's a variety of reasons, but I think for the most part, downtown markets still haven't fully come back on the hotel, in the hotel space. I think slowly and steadily, we do see some development projects and we do see some properties on sale in those markets now. So I do think that they're opening up. I mean, we're actually out on a large construction deal in Chicago. And I lived there for 12 years. And I could tell you that it's been the longest time since I've seen a new construction deal in Chicago. But I think slowly and steadily, these markets will come back. But just like how, as investors, people will start to take advantage of this space of buying properties at a lower price, I think larger companies will take advantage of these primary markets struggling and strike a deal. Like I think Google just recently went to Chicago in the Thompson Center, and they're doing a redevelopment there. I do think that new demand generators that have, old demand generators that have left, new demand generators will come in and, seize opportunity. But it will take some time for these markets to fully come back, because all the hotel business is like sort of secondary based on demand generators, hospitals, universities, events, airport business. And I think all those sort of demand generators have sort of scaled down since COVID.
Mm-hmm. For anyone, getting refis done right now, or maybe in the middle of an acquisition, do you see lenders pricing in an increased spread, or do you see them coming down temporarily in their spreads, just in the current environment that's snapshotted today?
Wait, can you repeat that question?
Yeah. So in the snapshot today, if we look at today's market this week, are you seeing lenders bake in increased spreads or come down a little bit on their spreads?
I mean, I think CMBS is already, I can't talk about this week. I mean, I would say end of last week, spreads were increasing. So,
and why is that?
Well, I think particularly in regards to CMBS lenders, there's been no new pool allocations. So all these CMBS loans, once they close, they get securitized in the secondary market, and there's been no pool to provide pricing for these allocations. So I do know that certain trading desks are using secondary market pricing for these, which then, obviously they're going to increase their yield to sort of make sure that the pool buys into these loans.
Yeah, got it. That's really good. Suraj, I appreciate you coming on, my man. This has been amazing. I think a couple takeaways here. Get ready for some buying opportunities. Make sure that you got your capital lined up, and with the tightening market, and tightening capital and debt market always comes with some opportunities. So we might see some volatility. We might see some rate cuts later in 2025. But most importantly, there might be some opportunities that shake loose from this. So excited to see how this plays out. Appreciate you coming on. Where can the folks get in touch with you if they want to learn more about working with you on the debt side?
Yeah, so I think the best way to contact me is email and phone. Phone is 773-314-7659. And my email address, I'm a capital advisor at Black Bear Capital Partners. So Desai at bbcp-llc.com. Always willing to help. And, we do have a lot of bridge financing options, some interesting options. So, and we're very active at SBA, conventional, CMBS, Life Co. So would love to work with you guys.
In addition to this, we'll have Alex Johnson drop Suraj your email, contact info, phone number, all that good stuff in the chat with all the other members. Suraj, I appreciate you coming on, man. It's been very helpful. Happy Tuesday, everybody. Appreciate you guys. Hope you guys have an amazing rest of your day, amazing rest of your week. I'll talk to you guys on the thread. See you guys.